Any
The order
questions?
block breaker, yes. I think I don't understand 100%. Sometimes I really don't understand.
What do you mean? Don't understand? What is it that is?
Example, you have an order block there, yes, and always have to wait till he go. Example, GU today, yeah. The order block was on the left side, but for entry, I have to wait till the candle is closed under the order block, right?
Yeah, the BMS. All right. So if this was your uptrend, this right, and then price goes up and breaks market structure, and this is your order block. This one here. This one. When price comes back, so I want to mute everyone right now because okay. Then whoever asks the question when I'm done explaining, then you can unmute yourself because I think someone is making noise there. Right. So as I was saying, all of these were return to order blocks. All these were return to order blocks, right? And then now we are waiting for a return to order block here, right? For price to go up, but then we get something like this now. Price breaks market structure. So once they break market structure, this order block here that failed, it becomes a breaker order block. It turns from an order block to a breaker order block. So it's from order block to breaker. Why? Because there was a BMS. It was violated. Then it becomes a breaker order block. So when the banks come back to, because remember, like I said, the banks bought here. They bought here just to take out this liquidity, to take out all these sellers. So once price breaks market structure here, this buy that they did, it is now in loss. They need to close it. So when price comes back to close that loss, then that's the return to break. And we can also sell with them. That's your break. If it was a downtrend, to look like this. So this was the return to OB, return to OB, and then this is the new order block. So we were waiting. We wanted to see a return. Then price breaks market structure, but then price now violates the order block, and now this becomes a breaker order block. A breaker order block. Just give me a second here. Who is it? One of the students sent me some charts on. Okay, just give me. I want to show you some examples here. I want to show you some examples. All right, so just give me 2 minutes. 2 minutes. Just 2 minutes. Okay, all right. So let me show you some examples here. Show you some examples. One of the students sent me some charts and they were really good, really, really good. I think almost all of them were about 90% of them were all correct. Okay. Okay, now here we go. So this is a breaker here, right? A breaker always takes out liquidity. Like I said in the old video, right? We get breakers at reversals, okay? Or you can get a breaker on a downtrend, like a lower low. When they make a lower high, they give you a breaker. Okay, this will be the breaker here. Okay, then they make a lower low. When they come to make a lower high, they give you a mitigation block like this. This will be the mitigation block here. Again, lower low. So these are lower low, lower high, lower low, lower high, lower low. When they come to make a lower high, they can give you a breaker again like this. This is the breaker. Okay, so here, this was what happened here. This was lower low, lower low, lower high. And this lower high took out liquidity. It took out these highs, and these highs. Okay, so when price broke below this order block, okay, because price has to come back and go up. So when price violates this order block, it becomes a breaker. So here we had a combination. We had a combination of a breaker, a combination of an order block. Okay, so it's return. This is a return to break and also return to order block. This one is a mitigation block. It's found in type 2, right here. Okay, so it's like this. So this is our return to mitigation block, this one, because of this. So like I said in the last video, we have easy breakers and mitigation blocks that you can see they are so clear. Then some are a bit advanced. They need you to be, you need to practice more to see those ones. Okay, so even this chart here, I think this one, even this one, they are more advanced for some students, but he saw them, so that's good. Okay, let's go to the next chart. Okay, this is another breaker here. Okay, so you see this. This order block here was used to push price down to take out this low. Or everyone who was buying here, who bought here, what the market realized is when they went up here, they realized that there was so much money here, a lot of money. So what they did is with this order block, they sold. They put a sell order, a big sell order, just to take out all these stop losses. Then once they are done to take out stop losses, price now goes up, and then it breaks market structure. So once it breaks market structure, this was a sell for them. They sold here. So now when price goes up, it's now in loss. This is a loss now. They need to close the loss. And when did they close the loss? They closed the loss here. This is when they close the loss. You know, these guys have a lot of money, so they can afford to wait. They can be in a loss of negative 100 million, and they don't care because they have enough money. They are the ones who control the market. So even this could have been maybe negative $1 billion, and they came back to close it here. So that's a breaker here. That was a breaker, this one. That's a breaker. It took out this low and this low. And then instead of us having a lower high here, there was no lower high, there was a BMS. So this can be also an advanced breaker here. This is a mitigation block. Okay, it's found in type 2. Found in type 2, right here. This is the mitigation block. And then this is the return. So this was the mitigation block here. And this was the return to mitigation block. This one here. So what they did is they first bought here. Then price goes up. And there are now new buy orders. So they want to buy again, but they don't want to buy up here. They want to buy low. So they push price down so they can buy here. So they first buy here, then they buy here again. Then when price breaks market structure, now it's in loss. They need to close that loss. They come back and close the loss. So a mitigation block is just used to push price down or up in premium or discount. It will not break market structure. A mitigation block does not break market structure here, but a breaker will. A breaker, this is the example. As you can see, the breaker will take out loss to give you a BMS or to give you a type 1.2. That's what the breaker does. So it's taking out liquidity like this. That's what happened here. So once they break above, this is now in loss. They need to close this, and they came back here to return to breaker. That's the return to breaker here, this one. This one here. So let me see. Because sometimes we have a combination of a breaker and an order block together. So let's see, was this a return to? Yeah, so this was a combination of two. A combination of a return to breaker and return to order block, both of them, the same area. This one is another return to breaker again, as you can see. There was liquidity here. There was stop losses here. So they used this order block here to push price down to take out the low. Then once they're done, price goes up, breaks market structure, return to breaker. That's the return to breaker. This was a return to also breaker again. Why? Because this order block here was used to, because this was a higher high. If you are looking at just area here, higher high, higher low, then price goes above. So we expect a higher low, something like this, but then there was a BMS, so it becomes a breaker order block. This order block was used to take out this low here, this low, take out liquidity. A breaker always takes out liquidity, either with a BMS or with a wick. This is the return to break. Another return to breaker here. Again, this order block is used to take out this high. And looking at our market structure, this will be a higher high. So we expect a higher low here, but there was no higher low. There was a BMS. So just like I said, a breaker order block is the order block that takes out liquidity or breaks market structure. And then it is violated. The second part is violated. There's a BMS. This is the BMS. So this becomes a breaker order block. And this was the return to breaker. Another example here, same breaker, used to take out this low, okay? But for this one, this breaker, the correct breaker on this setup here is this one. It's actually this one. But on the high, this is a 4-hour chart. So this breaker was a daily breaker. This was a daily breaker. Daily will be like this. This was a daily breaker. Okay, but for the 4-hour, the correct breaker is this one, the one that I marked here, this one. Well, this is the last order block to break market structure, to break this market structure. That's the breaker. But for daily, this is the daily breaker, which was returned here. This is a mitigation block. This one here, that's the mitigation block found in type 2, right here. This one, this is the return to mitigation block. And this is our breaker. And then this was also a higher time frame breaker. I think a daily breaker here. This is a daily breaker. But now because we are on 4-hour, there's so many candles. Another breaker here. This is the order block that was used to take out all these lows. People bought here. Retail traders, when they see this 1, 2, 3, they think of support. So they bought here, put their stop losses here. The market came down, took them out, broke market structure. Now this order block becomes a breaker order block, and this is the return to break. This is another. This one is so clear. Order block used to take out this high, and then there's a BMS, and this is the return to breaker. Right here. This is mitigation block in type 2. This one here. This This is another mitigation block, type 2 again. This is the return right here. Breakers, type 1. Mitigation blocks, type 2. Breaker, again here. This is the return. That's the breaker. Anyway, okay. Another example here. This is the breaker. Used to take out this high, and then this was the return to breaker. All right, so I think, yeah. The last one is this one. So now, any questions on the breakers? The mitigation block, another one. Okay, this is a mitigation block though. Type 2. Type 2, mitigation block. So that guy who asked him the question, do you understand now? Do you understand?
So a little, now I talk so a little bit, but I must watch this video. This video now was really good, but I must watch this, I think, alone, and and must do the homework. I must watch, train my eyes. Yes, but it's difficult, but I must learn this. Yes.
Okay, it's okay. You just need to. This is why I recommend people do homework, because
yes, you're right. You're right.
You can see, you can make the mistakes. I will correct the mistakes. Then you see where you make a mistake. Then you mark the right things. That's why when I say do homework, 50 charts, because sometimes if I say do 5 charts, maybe you are going to be lucky that day that you're just going to find 5 easy breakers, very easy. Then you say, okay, now I'm good. But then now the next day you're going to find, now maybe you're going to see a complicated breaker, like a difficult one. Now you can't see them anymore. So that's why I need you to do 50 charts, because at least you can see all the different types of breakers and mitigation blocks and how the market created those breakers, how they were made. That's why you need to do more charts, not just 2 or 5 charts. You need to do more. I used to have, I think there were now 3,000 charts. Yeah, I think I had now 3,000. Then my laptop fell and my hard drive died and I lost everything. But still, it's okay. But all I'm trying to say is that you need to mark these charts. Even when you are alone by yourself, mark the chart. Make sure that in your computer, there's a folder for market structure. And inside, there's at least more than 200 charts. Then there's a folder for order blocks. Again, more than 200 charts. For breakers, mitigation blocks, more than 200 charts. And for all the future lessons, again, there should be more than 200 charts. So that on the weekend, we can just go over the charts, just scroll and going through them, just to build your concept, so that you can see and make sure that your mind remembers those things. Because remember, our minds need repetition. Our minds, they need repetition for us to grasp something. You need repetition, to repeat a lot. So that's why you need to practice. Practice. Right, all right. Any other question before we continue? All right. What are the break and mitigation blocks stronger with the lower time frame order blocks? Are the breakers of mitigation blocks stronger with lower time frame order blocks? What do you mean by that? Because for us, our key levels are on 4 hour and 1 hour. That's where we mark our order blocks, our breaker, our mitigation block on 1 hour, 4 hour. Then when price comes back, then you go to lower time frame and look for an order block or a return to mitigation block or return to break. Everything that you do should always have a high time frame support. So our key levels are daily, 4 hour, 1 hour. Then when price comes back to those key levels, what are the key levels? order block, breaker, mitigation block. For now, yeah, for now. Also in premium and discount. Then when the price comes back to those areas, then you go to lower time frame and you look for a new return to order block or a new return to breaker or a new return to mitigation block. That is going to support your higher time frame key level. But if you're just looking for a break on the lower time frame with no higher time frame support, no. Yeah, that's true. If you find a breaker on higher time frame, then price comes back to that breaker. Then you can go to lower time frame and look for a supporting BMS to support that breaker. So if you find a breaker here on 4 hour, then when price comes back, you go to, like I said, go to 15 minutes or 5 minutes and look for a breaker, a new breaker or a new mitigation block or a new return to order block to support that breaker. Then you sell. Because if you don't get this, price might continue going up and you violate the breaker. So that's why we always want to lower time frame support. Lower time frame is to give us a BMS support that higher time frame key level. Right. So for today's lesson is what is it? AMD. Some of you, I think you already watched the video because I shared the video in the channel. I just gave it for free, both of them. But still, we'll do them. We'll do it again. Maybe some of the students didn't see the video, so we'll do it again. Right. So what is AMD? Where is the chart? This one. Daily range, daily and weekly range. Okay. So if you look on the daily chart, the candle will be like, if it was a bullish day, the candle will be like this. Okay. If it was a bearish day, the candle will be like this. Then sometimes you have those wicks and the ones that they call dojis and stuff. But a good day is like this, right? So when price open, if price is bullish, price will open here, come down to make the low of the day, go up to make the high of the day, come back and close. Okay, so the open is at 12 midnight. The close is also at 11:59 midnight. If it was if the day is going to be a bearish day, price is going to be bearish. Price will open here at 12 midnight, go up, make the high of the day, come down, make the low of the day, then come back and close. So this way we introduce the concept of power of three. What is the three? The three is the AMD, the accumulation, the okay, I put it in the wrong order. It's accumulation, manipulation, then distribution. Yeah, I put in the wrong order. But anyway, yeah. So this is one. This is number one. This is number two. This is number three. Yeah, that's the AMD. So let's look at the chart. So this was the bullish day. So the bullish day price will open here. Open here. Then come down to make the low of the day. Then go up to make the high of the day, then close. Okay. So this way we introduce the AMD. What is AMD? It's accumulation. So most of the time, if you realize that, you're going to notice that in the Asian session, price most of the time it will be consolidating. This is what we call accumulation. Okay, it's called accumulation. It's called a range. It's called a contraction. It's called a consolidation. It's the same thing. 4 different names, but same thing. So whenever price is in a range, whenever price is accumulating, they are picking orders. They are building liquidity on the top and at the bottom. That's what they're doing. Why? Because retail traders, they are taught to put stop losses above here and also stop losses below here. So the market, when the market is accumulating, they are accumulating orders in the market. They are accumulating orders. So after accumulation, you should expect a false move, a manipulation. That's the M now, a false move. So if price is bullish, okay, if price was bullish here. So let's say yesterday there was a higher high. This is the end of the day. So what price will do? They will do this, right? So this is the end of the day. So on the next day, price will come here. So this is our higher high. Then they'll start to accumulate. They are picking orders, and then they manipulate down. That's the manipulation. But also our manipulation is in line with market structure. They are coming down to make a higher low. This was the old higher low. This is the new higher high. So they are coming down to make a higher low. So most of the time, the AMD is in line with market structure. But before I continue, I need to say this. AMD, you are not going to find AMD every day. AMD is a confluence setup. It's a confluence concept. If it's not there, it does not mean that you are not going to buy and sell. You can still buy and sell. This is just a confluence, something to confluence our foundation. If it's there, it's good. It's something that you're just adding on top. If it's not there, still you can still trade. So it's just a confluence. So sometimes in 1 week you can see AMD maybe twice or 3 times in 1 week. And in those days where it was not there, you could have still traded again. You would have still gotten a setup. So it's just a confluence setup. It's a confluence setup. If it's there, good. If it's not there, still you can still trade. So now the manipulation is coming down to make a higher low. Once they are done with the manipulation, then price goes now price goes up. The original trend, it was higher high, higher low. They're now going up to make a new higher high. And this is now the distribution. The distribution is the correct move. Oh, that was fast. The distribution is the correct move now. That's the correct move of the day. Then they will come and close here. That's our AMD. And majority of the time, if you are trading non-Asian pairs, if you are trading anything which has no JPY, has no odd, has no NZD, what's the other one? What's the other one? This CNH. Yeah. Any pair which has no Asian currency on it, majority of the time, the Asian session is the accumulation. Then London is the manipulation. Then also London and New York distribution. So accumulation in Asia, manipulation in London, then also London and New York distribution. Right, so what are they doing? So this is the AMD, accumulation. This is a down day, it's a bearish day. Accumulation, then after accumulation, manipulation. Okay, what's the manipulation doing? It's taking out liquidity. Manipulation always takes out liquidity. They are taking out Asian highs and also maybe yesterday's high. That's what they're doing. So they're doing 2 things. Number 1, to take out liquidity, old liquidity. Which liquidity? The stop loss is here and the stop loss is yesterday. Number 2, they want people to buy on the wrong side of the trend. They want people to buy on the wrong side. So when some retail traders see this bullish momentum, they will think that it's a bullish day. So let's buy here. Let's buy. Then once they buy, price comes down. And now everyone is trapped here. And they take their money. So number 1, taking out old liquidity. Number 2, inducing buyers to buy. Then they take out their money later on when they distribute. That's what the market is doing. So just like the example here, this is the Asian session. Okay, so there's stop losses here and stop losses here on yesterday's high. So the retail traders, they are taught to put their stop losses above Asia and below Asia. And they are taught to put their stop losses on yesterday's high, previous day's high, which is this one. So now when the market sees that now there's so much money here and so much money here, they want to take them out. So what are they going to do? They're going to do a false move in London. This is the false move, fake move to take out this high and this high. Number two, they want people to buy. People to buy on the wrong side. So people are going to be buying here. Buy, buy, buy. And I want you to look at this thing. This is a bullish flag. This is what they call a bullish flag. So what are they? With the bullish flag, they are told that if price breaks above the bullish flag, you should buy. You should buy. It's a bullish day. So now when everyone is bought here and price comes down, takes out this high, and then now the correct move happens now. And now everyone who was buying here is trapped. They trap everyone up here. So this is our A, our M, our distribution. That's the AMD. So it's not always like this, okay? It's not always Asia accumulation, London manipulation, New York distribution. No, 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 no. Sometimes it's Asia and Asia and London are accumulation. So Asia accumulate, London accumulate also. Then New York now will give you the manipulation in the distribution. So if Asia and London are in manipulation, are in a range, you should know that New York is going to give you two things, manipulation and the distribution. Right, so this is an example here. Again, just like I said, Asia accumulation, London false move, manipulation, where to return to this order block. Then now, then they came back again for another manipulation. Then now they distribute. Now this is the M, and this from here, this is the beginning of the distribution. So distribute, New York, give you a retracement, then they continue going down. So most of the time, if it's a down day, if the distribution begins in London, New York is going to give you a retracement. A, M, then they begin the distribution, and then when it's New York, they'll give you a retracement to enter again, then they go down. So all of this is distribution. If it was a bullish day, accumulation, manipulation in London, then London begins the distribution. New York, they give you a retracement to buy again, then they continue going high. So this is our distribution. This is our manipulation. This is our accumulation. So we have two types of AMD. We have two types. I'll show you later in the charts. The first one is the easy one. If it's a bullish day, accumulation, manipulation, distribution. If it's a bearish day, accumulation, manipulation up, distribution. This is our type 1. Type 1 AMD. Type 1 AMD. And if we were using market structure would be like higher high, higher low, higher high. Market structure, lower low, lower high, lower low. Has to be in line with market structure. That's type 1. Type 1 AMD. Type 2 has two manipulations now. Type 2 will be like this. Accumulation, first manipulation, second manipulation, then distribution. That's our type 2 now. A, M1, M2, then distribution. Okay, and then if you go to market structure, lower low, lower high, lower low. BMS here, lower low. If it was a bullish day, it would be like this. Accumulation, first manipulation up, second manipulation down, then distribution. So A, M1, M2, then distribution. If you go to a higher time frame, so let's say this is 15 minutes. If you go to 1 hour and 4 hour, your market structure will be like this. Higher high, higher low, higher high. So most of the time it's in line with market structure. So this one is for me. This is for me here because I'm in South Africa. So this is for me. So in the morning, London begins at 9 a.m. Okay. So what do I expect? I expect a false breakout. Or sometimes we call it Judas swing to clear out liquidity from previous days high, low, or Asian highs and lows. Then price will then move to the opposite direction. New York begins at New York begins at 2. but right now it begins at 3 because of the daylight saving thing. So New York is going to give me a retracement for a re-entry. This is where you can use your Fibonacci now for your 62, OTE, 71, 79, 89. Yeah. But for us, we don't use Fibonacci because you know exactly where you know that price is coming back to the order block or the breaker. You know exactly where it's going to come to. So if Fibonacci is just like an extra added 2. Okay, let's go to the charts now. Where is my chart? Where is my chart? No, not this one. This one. Right here. So here, right, if you look at this chart here, this was a lower low, this was a lower high, a lower low. Now, if we go to the lower time frame, okay, if you go to the lower time frame, let's go to the lower time frame now. So just like I said, higher time frame, lower low, lower high, lower low. But now lower time frame, now you can see clearly this is the accumulation, this one. That's the A. All of this is accumulation. After accumulation comes what? A false move. This is the false move. Manipulation. Where return, where is it? This one. There we go. So our accumulation, where's the manipulation going? To return to this breaker, the breaker from yesterday, this one. Then manipulation, then now our entry is here. Wait, yeah, that was the manipulation here. Manipulation, and then